The next bill we have is 2114 from Chair Marquardt. Chair Marquardt, would you like to move your bill?
Thank you very much, Mr. Chair and members. I'd like to move House File 2114 be laid over for possible inclusion into the House Omnibus Tax Bill.
Chair Marquardt moves that House File 2114 be laid over for possible inclusion. We have the bill before us. Please present your bill, Chair Marquardt.
So thank you very much. Members, House File 2114 is a bill about bringing corporate profits that are earned in Minnesota and should be apportioned in Minnesota, but are shifted to other multinational subsidiaries and bring those tax dollars back to Minnesota. But maybe even more important, it's a bill about competitive fairness for small businesses, because as I kind of describe what is occurring here with profit shifting, is it puts our small businesses, our small Main Street businesses at a huge disadvantage because they're not able to shift profits that are earned in Minnesota out to their subsidiaries or their controlled foreign corporations. And in many cases, these small businesses are competing directly with these multinational corporations. So for members who have been here last year and that, I apologize, but what I do really want to do is go over kind of what is the history and the background of profit shifting and what has been kind of the efforts by the federal government and others to address it. And I know some of you have heard this already. Some of you are aware of this bill, but I know there's a lot in the public that are watching and others that want it. So, what is profit shifting? And that is what this bill really addresses. And that is when a domestic U.S. corporation here in the U.S. Shifts profits that are earned in the United States, but they use various methods to shift those profits to low tax nations. Mm-hmm. And they need to do this through controlled foreign corporations. They have to have subsidiaries in other nations to set this up. And so what this ends up doing is eroding and lessening the United States corporate tax base and ultimately Minnesota's corporate tax base. And so how big of a problem is it? Back when the federal government was looking at the Tax Cuts and Jobs Act in 2017, the nonpartisan Congressional Budget Office said that profit shifting probably is about $350 billion of income a year. 300 billion a year. And they thought with some of the provisions put in the Tax Cuts and Jobs Act that this might reduce it some to maybe roughly about $235 billion of profit shifting a year. A recent kind of paper on research on that said it really, the federal bill in 2017 hasn't really reduced the amount of profit shifting, but the paper did say in the long run it probably would reduce it 12 to 16%. So we're still in the $235 to $250 billion range of profit shifting. And how do we know that these dollars are being shifted? So in 2014, multinational corporations had to report their profits and where from. And in 2014, U.S. Corporations said they had $96 billion worth of profits in one country, in Bermuda. And yet the entire GDP, gross domestic product, in Bermuda is $6 billion. 96 billion of profits, only 6 billion's total country GDP. And in the Cayman Islands, the U.S. corporations reported $40 billion of profits, and yet there's only $3 billion of total in the whole country of gross domestic product. So we know that those are totally profits earned through profit shifting. It's not because of any economic activity that's occurred in those countries. And a lot of times we refer to those countries as tax havens. So how is the profit shifting occurring? So probably there's several ways, but the one that's probably the most prevalent is when a domestic corporation here in the United States will transfer what's called intellectual or intangible property. And those could be trademarks, drug formulas, patents, copyrights, naming rights, internet domain names, those things that are tough to value and so forth. And what they'll do is they'll transfer those to one of their controlled foreign corporations in a low tax nation. And then what they will do is they will either lease them back or pay royalty fees or buy back those rights. And so what that does is it increases the domestic corporation's expenses, which increases their deductions, which ultimately leads to lower income. So the income was earned, but by transferring out this intangible or intellectual property, they're able to, and then buying it back or leasing it back or whatever they do through royalty fees and such, they're able to increase their expenses, which lowers their income. And so, is this legal? Absolutely, it's legal. But is it right? And does it create huge competitive disadvantage? It creates huge competitive disadvantages. And so the federal government has dealt with this issue for over 40 years. In fact, in the early 1980s, there were 12 states that were using what was called worldwide combined reporting. And that is actually Representative Howard's bill. And they were doing this. And there's 1983 Supreme Court case that backed up the constitutionality of this approach. But some of the foreign countries and the corporations, they pressured Congress, and Congress went to these states and they said in the early 1980s, they said, if you kind of do away with your worldwide reporting plans, we're going to do all we can to eliminate this base erosion, and we're going to end this profit shifting. Well, 35 years went by and the problem only got worse. And so finally in 2017, when President Trump and the Republican Congress were looking at doing major tax reform, they understood that this was a huge problem, especially since the federal government in that act went to a territorial system on federal taxation, which means now you only get taxed in your foreign nation. And they thought, well, boy, with this, we better do some things. And so they came up with a tool. President Trump and Congress came up with something called Global Intangible Low Tax Income, otherwise known as GILTI. And I'm sure they had someone working overtime to come up with that acronym in Congress. But anyway, that's what it is. And there's a formula. And it's basically if there is a kind of what's called a supernormal income in relationship to the property assets you have in any nation, it's over 10%. They basically say, you know what, that's got to be profits earned from the transfer of intellectual property, and it's too much for the property you have there. It raises this red flag that in fact this is money that, even though it was earned here in the U.S., is being shifted out, and the profits being shifted out to another nation. So they put this in place. And so that's kind of the background of why we got to GILTI. So the big question now is House File 2114. What we do with House File 2114 is we use the federal government's definition of GILTI. And if a controlled foreign corporation triggers GILTI, we consider that controlled foreign corporation a domestic corporation. We bring it into the domestic corporation, we pair the income, and then we apportion that as we do the percent of all sales that were done in Minnesota, as we do currently, and then we take that and times it by the corporate rate. So basically, we are bringing that income in, considering it a domestic corporation. We apply the very same rules, the very same standards of that controlled foreign corporation as we do to a domestic corporation, and with all the benefits. So if, though, there's one other provision in this bill, if a company says, you know what, that one foreign corporation isn't representative of all of our subsidiaries around the world, they can elect, if they want, to go to worldwide combined reporting. And they have to elect that for 10 years. So whatever one would benefit them the most, they can do that. So what is the revenue estimate for the bill? It's $435 million for 22-23 and $381 million for 24-25. And so while this raises a lot of revenue, it's because it's a big problem. It's a big problem. But this bill isn't about revenue. It's about returning those dollars back to Minnesota that were rightfully earned there. And it's about increasing competition or leveling the playing field for these small businesses who compete with these multinational corporations. And yet they're seeing increased taxes because these dollars aren't coming in to the state to be used for other services and so forth. Members, you know, we've got to do something. This is an area of our tax policy that is broken, and we cannot allow corporations to just kind of arbitrarily set the amount of income that's going to be apportioned to Minnesota, the United States. And we also can't rely on the federal government to do any more as far as enforcement. And so the federal government has given us this tool on GILTI, and that's what we're going to use. So members, thank you very much for your patience and kind of going through the history and so forth. But that is the bill, and I'll open for questions.
Thank you, Chair Marquardt. So we have testifiers, we have a half an hour, and we have another bill. I'm going to set the parameter right now. Each testifier has 3 minutes. I will have a stopwatch that I will hit, and with their 20 seconds left, I will let you know. I'll say 20, so you can wind down, and I'd be greatly appreciated. All questions will be held until the end, and our first testifier is Miss Foley. Welcome to the committee, and please introduce yourself for the record and proceed with your testimony.
Hello, Mr. Chairman, members, thank you for having me. And I would just like to take this moment to acknowledge Representative Herr and Representative Moran. Thank you for calling out racism and misogyny. I really appreciate it, and I see you. I am a member of Main Street Alliance of Minnesota. I own Phoenix Grow Systems located in Anoka. We are a bookkeeping firm that works with small businesses. I have been doing this work since 2011. I've worked with at least 30 businesses during this time, and I focus our business is intentionally inclusive, and we focus on working with business owners from underrepresented and marginalized communities. As a small business owner, I can say that this measure would not negatively impact our small businesses. None of my revenue is sheltered abroad. None of my clients or contacts shelter their income in tax havens. A value of small businesses is that we generate income for local economies. We employ locally. We partner with other local businesses. Our customers are often local. Instead of harming small businesses, as might be claimed, this measure could help small businesses. This measure would tax big business. This would create a more level playing field for small businesses. Minnesota needs additional ongoing revenue to fund and create programs that support small businesses. This would give us the additional permanent revenue we need to fund access to healthcare, childcare, and funding capital for small businesses. Entrepreneurs take big risks when we start our businesses. There are very few, if any, safety nets. The pandemic highlighted this. A lot of us don't have health insurance. I don't have health insurance, and I know quite a few fellow entrepreneurs that don't either. MinCare and MinSure are inadequate for our needs. My premiums on MinSure were raised from $45 a month in 2018 to $200 a month in 2019. That's more than a 400% increase and was for worse coverage. To be clear, my income did not increase in a comparable amount. In fact, my income was down in 2019. It just wasn't affordable. A lot of small business owners, their families, and their employees would be more financially secure if the state made investments that put affordable, high-quality health insurance within reach, like Representative Schultz's bill to allow individuals and small businesses to opt into medical care. This would give more opportunities for current and new entrepreneurs, particularly those from underrepresented and marginalized communities. Please support HF 2114. Thank you.
Ms. Foley, that was incredible and efficient. I want to thank you for that. I just been notified by powers that be that we can push House File 2228, the Howard bill, to this evening if we don't make it. So next up, Ms. Dice, welcome to the committee. Please introduce yourself for the record and proceed with your testimony.
Yes, thank you. My name is Darwin Dice. I live in the country just outside of Ghent, Minnesota, where I raise chickens and host a community garden. I'm speaking in favor of House File 2114, partly because one of the big hurdles to passing legislation that helps people is we don't have enough in the budget. And those stalemates impact people who are really trying to get on their feet. I know personally of situations in my rural community where low-income folks who need programs like SNAP get cut off because they save precious dollars to buy a car, a pretty important thing in rural Minnesota. We need a car to get to the grocery store, obtain emergency medical services, get kids to after-school activities, etc. Also, I have friends who ration medicine and healthcare visits because they don't make the cut for Minnesota Care. Yes, such programs require the state to invest dollars, but the hardworking farmers, community members, and small businesses around me don't benefit when tax loopholes allow extremely well-off corporate entities to hide their money. Allowing the corporate world to hide exorbitant profits in hidden tax shelters enables taxable income to be withheld from supporting essential things like infrastructure, affordable housing, schools, developing broadband, so desperately needed here in rural Minnesota. We've got a high school student living with us who at times struggled with class participation, not because of lack of interest, but because of lack of internet speed. How many small business startups have we lost because of lack of broadband service? People in rural Minnesota spend their money to survive, which means it circulates in the economy instead of sitting in a hidden offshore account. I support closing loopholes, be it through HF 2114 or any other tax bill that closes loopholes, leaving more dollars in our community. I'm proud to live in this state, especially when we do not see our interests or struggles as separate from one another and take on the challenge to find greater balance and equity. House File 2114 works to do just that. Thank you.
Thank you, Mr. Dice. Very well done yourself, time-wise. Next, we have Ms. Larson. Welcome to the committee, and please introduce yourself for the record and proceed with your testimony.
Thank you, Mr. Chair. I'm Jill Larson with the Minnesota Business Partnership. My comments are directed at both House File 2114 and 2228 to save on time. While the bills aren't identical, they both deal with the concept of worldwide reporting, and we have some concerns with Minnesota moving to that tax system. This would be a significant change in corporate tax policy. It would make Minnesota an extreme outlier and would have really negative impacts on a lot of Minnesota's headquartered companies. No other state has worldwide reporting. And while technically not mandatory, House File 2114 essentially is that because of the way that the language is structured. We have concerns and questions about how the Department of Revenue would actually administer this new policy. House File 2114 gives the department broad authority to determine the unitary standard, which is unprecedented. Moving to a system of worldwide reporting would result in an extreme complexity of filing, added costs for both taxpayers and the department, probably be very difficult for the department to audit worldwide income, foreign subsidiaries don't have the same reporting requirements. And so it just adds a lot of complexity. But more important than that is that these proposals would make Minnesota less competitive and essentially penalize a lot of Minnesota headquartered businesses. You know, like non-U.S. companies, these Minnesota companies are competing around the world for business opportunities, for customers, for sales. And wherever those Minnesota companies operate, they are paying local taxes, whether it be income taxes, excise taxes, et cetera. But non-U.S. companies are not required to pay tax on income earned outside their own jurisdiction, as these bills would require Minnesota companies to pay. So this essentially puts Minnesota companies at a competitive disadvantage versus non-U.S. companies when they compete for business and investment. It essentially favors foreign-based companies. So it would be a big tax increase in a lot of Minnesota companies. We think that Minnesota should be working to encourage exports, encourage expansion into global markets, not penalize that expansion, not impede the ability of Minnesota's companies to compete. When these companies do expand, it creates good paying jobs here in Minnesota. So for these reasons, Mr. Chairman, we do oppose both of the bills. Thank you.
Thank you, Ms. Larson. Next, we have Mr. Nicely. I hope I'm saying that right. Welcome to the committee, and please introduce yourself for the record and proceed with your testimony.
Thank you, Chair. You got my name exactly right. I'm just like the adverb.
You must be a nice guy.
Well, you know, it all depends on the issue, right? In what perspective?
Well, we'll find out here. You got 3 minutes to whether you're nice or not.
All right. Well, you know, thank you very much. You know, really echo a lot of Ms. Larson's concerns with House File 2114 and also House File 2028, and both do have integrated concepts of worldwide reporting. The Council on State Taxation, in case some of you are not aware of us, we are a nonprofit trade organization. We're based in Washington, D.C., and we represent most of the Fortune 500 members. And we are not about no taxation. We are about fair and equitable taxation for multi-jurisdictional businesses. And we want both small and large businesses to thrive. Our goal here is not to hinder small businesses whatsoever, to make sure all businesses can thrive. You know, one thing I do want to note and make sure everyone realizes this is Minnesota's corporate income tax. For the most recent figures that we have, looking at fiscal years 2018 compared to 2019, the corporate income tax base actually increased by 21%. This is over the state average at the national level, which we saw from 2018 to 2019, it was a 17% increase. And a lot of this is related to the federal tax changes in 2017 that Chair Marquardt had discussed. So, you know, based on that, we don't see any urgency, a need for this massive change in how corporations are taxed in Minnesota. Specific concerns related to House File 2114 is how it treats controlled foreign corporations, and that it looks like it cherry picks those entities that are creating GILTI. However, if you have other CFCs that have losses, they would not be included in this approach. Now, there is an election to do worldwide combination, but just on its own, 2114, if you only had to include those creating GILTI, that it looks very much like it's one-sided and could be very inequitable. We're also very concerned with the revenue estimate. The revenue estimate appears to be based on other states that have tax haven provisions, and you know, looking at those having an 11% increase. And I know Montana is one state that has a tax haven provision. I don't think they've been able to show where they've had an 11% increase in their base. Addressing House File 2228, which would require combined reporting, you know, we really look at this as taking a step backward. And I know, you know, Chair Marquardt, you had mentioned how there was 12 other states that used to have this. You know, they did all eliminate it. There was a lot of pressure, as you had indicated, in the 1970s and the 1980s from foreign corporations and also from multi-jurisdictional businesses to eliminate.
20 seconds.
And, you know, I just want to say, you know, that when we want Minnesota to thrive, and we want Minnesota to remain competitive and not place businesses at a competitive disadvantage. So when it's appropriate time, I'd be happy to answer any questions. Thank you.
Thank you, Mr. Nicely. Okay, member questions for any of the testifiers or Chair Marquardt? And it looks like we have Representative Youakim.
Thank you, Mr. Chair. And this question goes to Chair Marquardt. Could you explain again I follow you. You're probably the only one that can explain this to me, so I appreciate that. Appreciate that. But could you explain again how Minnesota is a single apportionment state and how this works with that?
Chair Marquardt.
Thank you very much, Mr. Chair and Chair Youakim. So we are a single sales factor state, which means we only calculate the amount of sales a corporation does. So your payroll or your property doesn't make any difference at all. And so that's why if you look at, companies wouldn't relocate because it's based on sales. I mean, you can't take your customers and, with you, so to speak. And so the apportionment portion of it then is you figure out if you've got a company that does $1 million of sales throughout the United States, let's say, but does 100,000 in Minnesota, you would apportion it at 10%. That would be 10%. And so that way, of course, this corporation doesn't get taxed, many times over what they make. So it's apportioned based upon the percent of Minnesota sales versus their overall sales. And so when you bring in this corporate controlled foreign corporation, you would combine the income, but you also combine the sales. So the fact that none of the sales on this CFC were done in Minnesota would actually lower your apportionment of sales, but the amount of income could go up. So there's a factor, a multiplication there that has to take place.
Follow-up of Representative Youakim?
No, thank you. That helps. It makes me realize that this really wouldn't force companies out of the state. Thank you.
Thank you. Representative Sandell.
Thank you, Chair Lisgard and Representative Marquardt. I have a couple of questions about. I'm a little confused. First question is, would Minnesota be taxing proportionately the profits made on sales in other states? That's the first question. Second of all, how many of these Minnesota corporations are you talking about, and could you identify one or two or three? Thank you.
Chair Marquardt.
Yeah. So the first question is, thank you, Mr. Chair and Representative Sandell. So it would not impact any of the income from inside the United States. It doesn't impact that one bit. And so, a lot of these companies that might do the profit shifting through naming rights, and that could be drug companies, software companies. I know Apple, when we had deemed repatriation, I think they were the largest one for bringing back foreign profits, and not saying all of those were shifted, but those would be the type of businesses or corporations.
Representative Sandell.
Thank you. Just quickly, Chair Lisgard, would this affect corporations selling goods such as refrigerators or whatever, or would it also include corporations or partnerships making financial transactions, and where the product may be simply a financial investment?
Chair Marquardt.
So, Mr. Chair and Representative Sandell, remember, this is only activated if the corporate or the controlled foreign corporation activates guilty, which is section 951 of the IRS code. So, I'd have to dig into that more on that specifically, but if it triggers that, which means their income is more than 10% of basically tangible assets that they have in this country, it is just signifying, sending up the red flag that this is probably profit shifting. And so I guess I can't answer that specifically, but it would be contained in section 951 of the IRS code.
Any follow-up, Representative Sandell?
This last, I'm sure you know, Representative Marquardt, that I support the bill and the conversations that we've had about things like this. But my concern is, of course, that I don't want to penalize Minnesota companies. I should say I want to support Minnesota companies because so many of our products, of course, are coming from Southeast Asia and China, and you know, the hockey sticks I used to buy that were made in War Road are now made in Vietnam, and I don't know why we chased the Christian Brothers out of War Road. But thank you very much. I appreciate the bill, Paul, and Representative Marquardt, and thanks, Representative Lycett.
Thank you, Representative Sandell. Representative Miller.
Thank you, Mr. Chair and Chair Marquardt. I oppose this bill. And usually the narrative is when a middle-aged white guy Republican opposes a bill like this, we're trying to defend big business. That's the narrative, right? Well, I actually defend the consumer on this. Members and other people listening, corporations don't pay their taxes. Their customers do. That cost gets shifted down to the next level, because they're going to have profits that they're expected to have and what have you. And we can go into whether businesses move or not, but the bottom line is that when we find new ways to tax these businesses, the consumer ends up paying for that in the end. And I'd also like to add that Minnesota has enough tax revenue also, and we're talking about increasing tax revenue. Members, we don't have a revenue problem, we have a spending problem. So I think we need to find ways to lessen the burden on the consumers here in Minnesota, not increase it. Thank you, Mr. Chair.
Thank you. Chair Marquardt.
Mr. Chair and Representative Miller, you bring up a great point. And the DOR, when they look at tax incidents on business, says it's regressive and a lot of it falls on consumers. But the Department of Revenue has also indicated that when it comes to national and foreign corporation, it's a different story. In fact, what they say here, and this was from a tax incident report on the 2018 tax bill, it says, quote, businesses selling in national or international markets are much less likely to shift the added cost to consumers by raising prices or to reduce the price in response. We know, and a lot of folks are recalibrating all of this because corporations in Minnesota received a 40% tax cut in the Tax Cuts and Jobs Act when the corporate rate went from 35 to 21. And yet we didn't see a lowering of prices. And what we saw actually, according to the Federal Reserve, is that stock buybacks from the fourth quarter of 2017 to the first quarter of 2018 went from $23 billion to $55 billion. So a lot of it was put back into the company. And so I share your concerns with regressivity and so forth, but when it comes to something like this, where you're talking about international corporate dollars, scholars and even the Department of Revenue says that might be a little different. And the last thing is I want to emphasize is this, while it raises a large proportion of revenue, this isn't about revenue. This is really, you have your small businesses that are competing with these global corporations and they're selling the same product, but they're paying more in taxes than what they should be in comparison to this corporation that has the means to be able to shift it. Now, again, it's legal. We have great corporate partners in Minnesota, but you know, I've heard kind of concerns about what it might be doing, but I haven't heard anyone say how are we going to fix the problem. This is one way in which we fix the problem, and these are domestic dollars that should be taxed in Minnesota. They should be taxed in Minnesota, everything else being equal, but they're able to shift that out. And not only does that increase taxes for our businesses, but it decreases the amount of resources we have for our schools and healthcare and public safety and all the other areas. So I know it raises a lot of revenue, but it's trying to fix a problem. because it's a big problem. These are dollars that should be apportioned to Minnesota.
Chair Lizagard,
Representative Miller.
Chair Lizagard and Chair Marquardt, we can somewhat resolve that issue by lessening the tax burden on our local businesses as well, which are entirely overtaxed in the state of Minnesota too.
Thank you for your comments, Representative Miller. Anyone else from any member want to ask a question, say a comment? Seeing none, closing comments, Chair Marquardt.
No, members, Mr. Chair and members, thank you for this. This is something we need to address. The federal government has tried to address it, and they set it up so that this income passes down to the states. And they've given the states a tool to be able to address this problem. And I think this is one way, a fair way to do that. So members, thanks for the debate again. I would renew my motion to lay over House File 2114 for possible inclusion into the House omnibus tax bill.